Buying or selling right now might feel overwhelming, especially with the way interest rates have been going lately. But what if I told you there's some smart financing strategies available today that can help buyers to get a better deal and sellers to get top dollar? In today's interview, we're going to sit down with a great mortgage broker to go over a tool that most buyers and sellers don't even know exists, and that's rate buy downs. Rate buy downs, along with other financing options, are tools that buyers and sellers are using right now to get deals done. Whether you're a buyer looking to lower your monthly payment or a seller looking to attract top dollar offers, you're not going to want to miss this interview. Now, having said that, let's get on with the video. Hey, everybody. We're here with Michelle, a mortgage broker I've worked with in the past, to talk today about rate buy downs. I think rate buy downs are super important because it's a tool that I think a lot of buyers and sellers don't really know about. And it's also a tool in your market if you have new construction that big builders are using in order to entice buyers to buy their homes. So a lot of times people think we're just talking to buyers. However, if you're a seller watching this video, you might want to pay attention because you want to know what your competition's doing. So let me introduce you to Michelle Kattula, a senior loan advisor with Aequitas Mortgage. I hope I got that right. A multi-state licensed mortgage broker known for creative, fast, personalized lending solutions. Michelle specializes in helping buyers, sellers, and agents craft winning offers, even in high interest rate environment. Through custom financing strategies like rate buy downs, alternative documentation loans, investor programs, and first-time homebuyer grants, Michelle is passionate about educating clients and partners so they feel empowered and equipped throughout the whole home buying process. Her clients often say she brings clarity, strategy, and results to every transaction. You know what, Michelle? I can totally agree with that. Welcome to the show.
Thank you very much. Thank you.
All right. So, Michelle, the purpose of today's call is not really an introduction to mortgages or whether it's a good idea to get a pre-approval, which, by the way, it totally is. But today we're going to dive in how creative financing like rate buy downs can make home ownership more affordable and help sellers use these tools to attract serious offers. And before we continue, I realize for some people, especially buyers, these can be uncertain times, especially if you're watching the news, listening to all these people out there. Some people in these type of environments might choose to sit on the sidelines and wait it out for interest rates to come down or for the news to tell them that everything's okay and all their neighbors are buying houses. Obviously, Michelle's going to touch on this a little more, that sometimes trying to time the market rarely works. I mean, if I could completely time the market myself, I'd be living on some island somewhere, be super rich. So nobody can time the market. However, we can make decisions based on our time frame we decide to be in that home. And generally speaking, if someone is living in a home 5 years plus, they're going to see their equity grow. And I think you'd agree with that, right?
Absolutely.
Yeah. One last thing I want to add is I was licensed in 2007. So I went through all that 2008, 9, and 10, which was a very rough market. But what I will say is the small amount of people, buyers, who had the finances and ended up buying during that time absolutely made a killing in the market. While a lot of people will wait and see what everybody else is doing, as long as you have a financially secure plan and know where you're going to go, it's always a good time to buy. And this is what I think we're going to show you today. Okay, so let's start with the basics. What is a rate buy down and how does it work?
Yeah, so a rate buy down is a financing strategy where upfront money, whether it's paid by the buyer or the seller in the transaction or potentially financed with the lender, is used to lower the interest rate on a mortgage, either permanently or temporarily. And this will reduce the borrower's monthly mortgage payment, which will improve affordability and allow you to have more room on your monthly expenses and lifestyle.
And who typically pays for this buy down? Is it the buyer, the seller, or the lender?
It can be any of those things. So the buyer can pay for the buy down. They can do like a permanent rate buy down or a temporary rate buy down. If you decide to buy your own interest rate down through discount points, you can buy out a little bit or you can buy out a big chunk. That depends on what your financial goals are. If the seller is paying for your buy down, how that works is you can essentially request seller concessions as part of your agreement. And when you request seller concessions, that can go towards closing costs and or the discount points that will be buying down your interest rate on a permanent rate buy down. And then if you want to do a temporary rate buy down, there's a different cost for each temporary rate buy down. We can talk about all those different temporary rate buy downs. So buyer or seller or lender, a lender can offer a credit at closing that can be applied to your discount points or towards your closing costs.
Okay. No, that was a great explanation. So just to be clear, it's not that complicated to do this, is what you're saying. Like, so, I mean, for instance, let's just say it's a buyer and they're making an offer on a home. They can ask for a seller credit. And then with that credit, they can choose to use that to buy down their rate. Is that what you're saying?
Yep, exactly.
Perfect. I do want to add, I think I said it a little earlier in the video, but this is a tool that big builders are using, like big national home builders are using aggressively right now. So if you're a seller out there listening to this, like keep it in mind. Like I'm not telling you what to do, and you work out your strategy with your mortgage person and your realtor and your financial advisor, but just know that your competitors are using these tools in order to possibly pull buyers away from you. So that's all I wanted to say. Okay, moving on. So Michelle, can you tell us what are the typical costs of a rate buy down? So for example, how much, if someone's buying a $500,000 home and they're buying it with a conventional mortgage, so they're putting 20% down, what would be the monthly savings if they bought the rate down 1%? And also how much would that cost?
Yeah, absolutely. So the typical costs of a rate buy down on a $500,000 home, let's say you're putting 20% down, your loan amount will be $400,000. So a lot of the numbers that mortgage brokers deal with are based on your loan amount. Sometimes people think it's based on the purchase price. It's actually based on the loan amount because that's what I'm working with. Not working with the purchase price, we're working with the loan amount. So for a $400,000 loan, expect to pay about $4,000 to lower the rate by 1%. And costs can vary depending on the day, depending on the year, whatnot. We'll just go on a hypothetical situation for an interest rate. We'll throw some numbers out there. And if we were to break it down, let's say the interest rate that you would qualify for, given your credit score, your down payment, your debt to income ratio, all that fun stuff is a 7.25%. If you were to buy that interest rate down by 1%, that would cost you $4,000 because 1% is $4,000 of a $400,000 mortgage. Principal and interest at a 7.25%, you're looking at $2,728 per month. And then if you were to do that $4,000 rate buy down, which could come in seller concessions, or you could pay in discount points, you would get a 6.25%. And your monthly payment for that would be $2,462. So you're saving $200 to $300 a month on that rate buy down. I mean, imagine what you could be doing with $200 to $300 a month.
Wow. Well, like even if you do the math, if you're spending only $4,000 and let's say you're saving $250 a month, I mean, in less than 2 years, you're already in the positive for doing that.
Absolutely. Yeah.
And that's crazy, right? Like, I mean, and look at it this way. A lot of buyers or even their agents might not know this, but so they'll go and they'll buy the house for 500,000 and maybe they're like, let's negotiate and let's offer 495,000 and they get it. That's really not going to make a big deal on their mortgage. However, if they say they did agree, and I'm not saying you can do both, you can negotiate the price and you can try and get seller concessions, but if they just got that 4,000 put into a rate buy down, they'd be so much better off, especially if they live in the house for 5 years or more.
Yeah, absolutely. A lot of times people focus on the purchase price when in fact you're saving $5,000 based on your example, but here, you lower the interest rate, $5,000 over 30 years is nothing in comparison to $15,000, $16,000 over 5 years. And obviously that number grows and grows every single year.
That's a really powerful tool, Michelle.
Yeah, absolutely. And I'm so glad we're here talking about this. That way people can start taking advantage of this tool.
Yeah. Okay. So moving on, now I want to talk about strategies for buyers and then we'll get to sellers after this. So my first question to ask is, besides rate buy downs, what other creative financing options are out there for buyers?
Absolutely. So there are ARMs, which are adjustable rate mortgages. Now, I know back in 2008, a lot of people did ARMs And what they did was they qualified that borrower based on the initial rate, which is typically the lowest rate you're going to get in the life of the loan, unless the market gets significantly better or even a little bit better. And so that was their mistake back in 2008, is they qualified that borrower based on that initial payment. Nowadays, the ARMs are different. So let's just take away the negative stigma around ARMs. ARMs are a great product. Most people don't even stay in their mortgages for more than 5 years. And a lot of ARMs, have that 5-year period where you get that low interest rate in your initial payment. So now how you qualify for ARMs is based on what the max rate could go to. And now we have these caps put into place so that if the market goes bonkers, then, your interest rate will not go insanely high. It will go to a capped amount, and you will be educated on what that capped amount is and also qualified based on what the highest rate could be. But you'll be making those lower initial monthly payments at the beginning of the ARM, whether it's a 3-year ARM or a 5-year ARM. So an adjustable rate mortgage allows you to be put into a lower interest rate at the beginning. And then as the market changes, the rate will adjust according to the market, but you're locked in at that low initial interest rate the first few years. And so the lender is basically, taking that risk on giving you that lower interest rate and then compensates that for potentially higher interest rates down the line. But you could also refinance before that low interest rate period is even over and get into potentially a better mortgage. So those are definitely a great program to use in a market environment like this, where right now interest rates are around, 7.5%, and you could potentially get into an ARM at 5%, 6%.
Okay. Michelle, just a quick question. So with adjustable rate mortgages, is there any product out there where, say I'm a buyer and I decide to go that route because I believe interest rates will go down over the next year or two? Is there any way that I could convert that into a more like a traditional mortgage, like a fixed term rate? And what are the costs on that? Or is that like doing a whole new mortgage, or is there any products that kind of meet you in the middle?
So the ARM, if you were to stay in the ARM, that would kind of meet you in the middle because the adjustable rate mortgage adjusts to the market. So if the market does get
so if it goes down, you win.
Yes. Yep. Exactly. But if you are like, I don't want to gamble and see how long this winning market is going to continue, let's lock in a fixed rate for the next 30 years. You can absolutely refinance your mortgage, and a refinance is way easier than a purchase. So, and hopefully by the time you get to that point, you have already, at 20% equity in your home, you might be more likely for an appraisal waiver. We can close that in like 10 days. So,
okay. All right. Perfect. No, really good. Okay. Aside from adjustable rate mortgages, can you tell people, we did talk about rate buy downs, but I know there's also temporary buy downs. Tell us about those and what's the difference?
Yeah. So being a mortgage broker, I have access to so many different types of rate buy down programs, one of them being temporary rate buy downs. And we actually have 3-2-1, a 2-1, a 1-1, a 1-0 buy down. So we have 4 different temporary rate buy downs that you can take advantage of. What those numbers mean is how much you are buying your interest rate down and how long it's going to last you. So for example, for a 3-2-1 buy down, in the first year of your mortgage, you will be 3% less than the market interest rate is currently. So let's say today interest rate is at 7%. You can actually get into 7 minus 3, which is 4% interest rate, which people would definitely refinance their homes over to save lots and lots of money. And then in the second year, your interest rate would go minus 2% of what the current market is. So you'd be at a 5% interest rate. And then in the third year, you'd be minus 1% of what the market interest is, which would be at a 6%. So in a 3-2-1 buy down, essentially you're getting a 4%, a 5%, and a 6% over years 1, 2, and 3. And then ease your way up to what the market interest rate is. And hopefully by then the market's better and you can refinance into a better interest rate anyways.
Okay. Actually, that just led to my next question. So, I mean, getting 3% off the current mortgage rates is amazing. What would stop somebody from getting into one of these mortgages and then 2 years later, once they lose the 3 and the 2%, go, okay, now I want to refinance my mortgage? Like, is there any penalty or anything for doing that?
There's no penalty for refinancing. There is one thing to take into consideration. If you do refinance before that 3-2-1 period is over, if you paid those discount points and the seller didn't pay that discount points, you kind of feel like you lost that money. But depending on what lender you work with, they may be able to recoup that money and put it into an escrow account for you. So you can take advantage of that if you want to refinance before that 3-2-1 period is over, but make sure that whoever you refinance with is somebody who can take that money and put it into an escrow account. That way it doesn't get lost.
Gotcha. So basically the 3-2-1 is much more aggressive to get a 3% off in the first year than it is to spread it out over the life of the mortgage. So, okay, I got what you're saying. Aside from that, sellers can also give credits towards closing costs and things like that. But I wanted you to explain a little more about grants and down payment assistance programs, especially for like first-time home buyers. I know there's a lot of programs out there, so we'd love to hear more about that.
Yeah, absolutely. So there are down payment assistance programs. Most of them are tied to FHA programs where you are able to get a grant through a lender. And a lot of those times, those programs, they have additional guidelines. So you always want to make sure you're talking to your mortgage professional about what those guidelines are and what you need to meet. There's so many down payment assistance programs out there. So make sure you do your homework or work with a mortgage broker who does the homework for you and shops around at all the banks and lenders that they could be utilizing. And with those down payment assistance programs, make sure you understand all the terms and the guidelines. Sometimes they are pure grants, which is amazing. Nothing you ever have to pay back. And sometimes they are what are called silent seconds, which is basically a second lien on the home that if you decide to ever sell or refinance your mortgage, you would have to pay that back upon that transaction being due. So make sure you do your research and understand what exactly you're signing up for when you are doing these down payment assistance programs. Another program we actually just came out with today, very exciting, is a 1% down program. Where you only have to come in with 1% down payment plus closing costs, which sometimes sellers can pay for too, which is great. But the lender will provide a 2% grant. So a lot of people think you need to go 20% down to get into a home. You actually only need 3% or 3.5% if you are a first-time home buyer. FHA allows you to go at 3.5% down, whether you're a first-time home buyer or not. And if you're not a first-time home buyer, you can actually get into a home at 5% down. There's definitely a lot of different programs out there that people can take advantage of so that they can bring less money to closing and start their real estate investments today.
Oh, that's great. One last question I do want to ask you. So maybe there's a buyer watching this video and they're like, oh my gosh, like I'm going to get everything paid for by the seller because they can't sell the house. However, we do know that lenders have a certain cap on incentives. You can't just make it 50% of the price in a seller concession. Can you quickly, I know every lender is a little different, and there's regulations. Can you just give us a brief overview of what you could possibly get as a buyer?
Yeah, absolutely. So depending on what your down payment is and what program you're in, there is a cap on seller concessions. Absolutely. So with a conventional mortgage, depending on how much you're putting down, if you're putting 25% down or more, you can get up to 9% of seller concessions. If you're putting less down, then that means the amount of seller concessions you can get will be lower. It could be 6%, could be 3%. So there's different factors, but the most you can get on a conventional mortgage is 9% seller concessions. And then on FHA, the most you can get is 6%. But definitely make sure you talk to your mortgage broker, see what the max seller concessions is that you can get whether that's towards closing costs or whether that is towards your discount points to help you get a temporary rate buy down or a permanent buy down, and see what can apply to where, because sometimes there's a max you can apply to discount points, or there's a max you can apply to closing costs, and there's a max total. So make sure they give you that breakdown and see exactly what you can work with. That way you're not asking for more than you have to from the sellers. Let's say you ask for 15% seller concessions, then listing agent might be like, whoa, like, this is a little crazy
but
here.
Even if they agreed to it, even if everybody agreed to it, guess what's going to happen when the documents get sent for underwriting? Like, it's not going to work.
And another thing to consider as well, sometimes what people will do, a lot of builders do this actually, they will raise the price of the home and apply seller concessions to the buyer. And you have to make sure if you are raising the price of the home, that the home still appraises. Because if the home doesn't appraise for that amount, then you can't get those seller concessions. The seller concessions will only work if the home appraises for that value as well.
No, that's great information. It could be a little daunting. However, there's lots of options out there. What I'd like to add is, a lot of people, they kind of separate, like when you're buying a house, and we're just dealing with buyers right now, you're getting this team. So you have a real estate person, you might have an attorney, you might have a mortgage person, but if they're not talking, because you're going out and calling this person over here and this person over here, this is where the miscommunication can come in, right? So it's always good to make sure your realtor at least touches base with your mortgage person. Like I always do that. Like, what do they qualify for? Send me the letter, but also what can we do when negotiating with concessions and things like that? So I think that's really important.
Absolutely.
All right. So let's move on and let's talk quickly about strategies for sellers. And I'm going to start off with, how can a seller use a rate buy down as a marketing tool?
Well, a lot of people right now are very concerned about everything costing a lot. It's a big concern, around a lot of the people that are in the market to buy a home. And when you are offering seller concessions, this is definitely a marketing tool where you can bring buyers in and basically let them know, like, you're going to work with them. You're going to let them know that you are offering, let's say, in our previous example, 1% of the purchase price of the home can go towards seller concessions, can go towards discount points. You are marketing yourself and letting people know, like, we are doing something for you that not every listing is doing for you. We're giving you some sort of discount, right?
Okay. And well, since we're at that, I think I know the answer, but I thought I'd ask it anyway. Always good to ask questions, even if you think you know the answer. I mean, if the seller's offering a rate buy down, they're just essentially saying they're willing to offer a concession, correct?
Mm-hmm. Right.
So at the end of the day, the buyer still needs to qualify for whatever it is they agree to, correct?
Yes.
And that leads me to my last question. Do sellers need to work with any specific lender to offer this, or is it just done universally because they're just offering a concession?
So the permanent buy downs are pretty universal, whether the buyer or the seller is paying for it. Seller concessions are universal as well. The conventional FHA guidelines apply to any lender. The temporary rate downs is where it starts to get a little more specialized in what they can offer. I know not every private bank or in-house lender will offer a 3-2-1, a 2-1, a 1-1, and a 1-0. They might offer a 1-0 or a 1-1, but not typically all four. So the temporary rate buy downs, if that's a product you want to take advantage of, that's something where you're going to have to get into a little bit more of a specialized loan officer.
Gotcha. And I mean, that makes it a little more difficult because in a traditional resale setting, generally speaking, the buyer already has a pre-approval with a certain lender and they're all set to go there. Whereas if the seller went and said, okay, I have this special lender that's going to give a 3-2-1, it doesn't mean they're going to use them, right? I think when it comes to big builders, new construction, that's a little different because a lot of times they end up getting the buyer to use their financing company. And I think that's why you might see that kind of financing more popular. But definitely the traditional rate buy down is a great option, I think. And I think a lot of buyers, again, if they're staying there longer than 3, 4, 5 years, they're going to make a killing off the rate buy down. One question I just came up with from the standpoint of especially a buyer, I don't think from a seller, it's not really a risk. I mean, they're just willing to give a concession. But for a buyer, what could be a possible risk to putting funds towards a rate buy down?
There's not really a risk, other than kind of what we discussed earlier is if let's say you close on your house today, you do the 3-2-1 buy down, and then in 8 months, the market gets insanely better. We're back at 4%, 3% interest rates.
So they basically lost all of it.
You can recoup that money. Like we had mentioned, you can put it into an escrow account. But if you don't have an escrow account, there's still other creative ways to apply it to your next mortgage. You can apply it to your closing costs. If you decide to refinance, you can find a way to make it work. But if you're not working with a lender who offers any kind of way to make it work, then you are kind of losing that money. That's the only risk. If you as the buyer are paying for the temporary or permanent rate buy down. But obviously, if the seller does it, still lost money, but it's somebody else's money at least.
Oh, that's pretty funny. I mean, listen, at the end of the day, this is where you have to kind of have an outlook of 5 years. Yeah, if you do your research and you've looked at all options, including what's worst case scenario, what's best case scenario, most time people will figure out the best course of action. It's just important that these tools exist. I like to reiterate, okay, fine, interest rates go back down to 4%. If you're in an area that's in high demand, that means all these buyers start coming back because there's a lot of people thinking just like you. And that could actually force prices up, and you might see all these incentives disappear. There's always a balancing act, but right now there's some great deals out there. So, I mean, if financially able to do it, always make sure I'm not telling people to risk, their financial future over it, but if you are able to, and you're just kind of sitting there, I think these tools give you some more options to, bring you into that zone.
Yeah, that's a great point that you made, is take advantage of these tools right now while they're available. If you wait for interest rates to go down, those prices are going to skyrocket. And when those prices skyrocket, you're paying more for a house, and you could have saved more on the price of the home and on the interest rate by taking advantage of the seller concessions that they would be offering in a less mobile market.
Great. That's great advice. Okay, so now we're going to end off. I hope everybody has a better idea of rate buy downs and how they can help you, whether you're a buyer or a seller. Now, for the last part of this interview, I just want to fire off some questions to Michelle on the current market conditions and any type of advice she can give. And as always, if you have any questions, Michelle is licensed in multiple states. We're going to put all her information on this video. It'll also be in the description, whether you see this on YouTube or social media. I highly recommend you reach out to her. She'll be happy to answer any questions. So having said that, let's just fire off a last couple of questions before we go. So first off, what do you think? How are interest rates trending right now? And how should buyers think about rates when planning to buy in the next 6 to 12 months?
So far, we've all kind of been waiting for interest rates to drop. If you are in the market for buying a home, talk to your mortgage professional and see what the best strategy is for you and how you can attain affordability, more so than focusing on what the market is doing, because the market is something nobody has control over. And working with the mortgage professional, they're going to find the right strategies to get you into the best payment. Keep your mindset focused on payment rather than interest rate. See what you can do to utilize all the tools that your mortgage professional has.
Oh, that's a great answer. And yeah, I also like to say, like, you might be looking, whether it's a buyer, well, let's talk about buyers. A buyer could be looking at a home, and let's say it's priced at 500,000, but they should also look at, okay, what was that house worth in 2021, 2022? It might have been worth 575,000. So while yes, your interest rate might be higher, there might be a huge chunk that's just come right off the price before you even negotiate any of these rate buy downs or money off the price of the home. So I think people need to keep that in mind, because I don't, at least for me, and I'll ask your opinion after this. I don't think prices are going to come down that much. Yes, they fluctuate based on market conditions, but I mean, ultimately, the reason prices are double what they were 10 years ago is that our money's worth less. Like at the end of the day, it costs more to build a property. You can't build it for the same price they could in 2015. There's a lot of additional costs that there's no way to lower the prices of those homes. And last thing is, I'm still seeing these big corporations and hedge funds buying up all these houses to put them into the rental pool. So they're obviously betting on the housing market, regardless of what the interest rates are like. So yeah, I
Yeah.
just people to keep that in mind, right? Like I don't, we're not going back there. I know there's some people that like to talk and say, oh my gosh, but I don't think it's going to happen. Like the financial system's much stronger. It's not like all these houses are going into foreclosure. It's just slow because people don't know, our rate's going down in 2 months. Like, I think that's the
Right.
big thing. Any thoughts on
Yeah.
that one?
Yeah, I think the real estate market is a strong market and it's definitely worth putting your money in. And if you invest today, I think your investment will definitely come back with a solid return. And to your point, I have a client that I've been working with for a couple of years now, and he has somebody in his ear telling him, "We're going to get a new administration. Wait for the new administration. Let's see what's going to happen." Then, the new administration comes in. I have a theory the market's going to crash. Wait for the market to crash. The market didn't crash. Then I have a theory that it's like you've got all these people in your ear telling you all these different theories about what the market could do. I think one thing is for sure, the market's been doing nothing but increasing in value. And I think the real estate industry is definitely the place to put your money.
Yeah, Michelle, listen, I have people I worked with in 2008 that could have bought a house for 300,000 that now is worth 1.2 million dollars. So we're almost 20 years past that. Yeah, it hasn't gone down that much. Yeah, maybe prices go down 5%, 7%, but they usually bounce back up once rates and things like that change. So yeah, I caution people, look at everything going on. I just don't see that type of reset. And I mean, but it's natural, right? Like you watch the news and stuff like that. Like I said, I got my license in 2007. I remember my father-in-law going, "This market's never going to come back." Like, wow, that's real encouraging when you're a new realtor. But I stuck it through, and guess what? His house is worth a hell of a lot more than it was back then. So he's not complaining anymore. So I'll just leave it at that. Okay. Any final tips on you want to give out to whether it's buyers, sellers, or anything to do with mortgages? It's here. Now's your time.
Yeah, so I want to encourage people to always look at the option of potentially doing an FHA mortgage. FHA interest rates typically do tend to have interest interest rates. We did also recently come out with FHA ARMs. So you're getting, the FHA pricing plus ARM incentives. So you're getting like really, really low interest rates with FHA ARM combination type loans. FHA, you'll always have mortgage insurance no matter how much you put down, right? But even if you're paying that mortgage insurance, your payment can still be less than a conventional mortgage. So if you are really, really trying to tap into home affordability and lower payments, and FHA might be the way to go. And I know a common misconception is FHA is only for first-time homebuyers and for people with bad credit scores, and that's just not the case. You can have a good credit score. You don't have to be a first-time homebuyer. You can get in as low as 3.5%. So don't completely wipe FHA out of the possibility.
Okay. And Michelle, I know you do this, but I'll bring it up. Like if people are, have different ideas in their head, like you're happy to go through like, hey, this is what this is going to look like as an FHA, or this is this is going to look like as a traditional mortgage. Like you can break those down and go through the cost line by line, right? And they can decide basically what's better for them, correct?
Yeah, absolutely. We can go through every single option that is applicable to you as a buyer, and you can make the decision based on what your goals are.
Great, great. All right.
Mhm.
Well, Michelle, this has been a great a talk today and provided a lot of information. So thank you. So now that we're ending, can you tell people how to contact you? Any other information you want to give about yourself before we end this call?
Yeah, you can call me, text me, email me, DM me. Either way is fine. My phone number is 586-383-3538. And my email address is my first initial last name, which is mkattula at aequitasmortgage.com.
And for anybody watching, if you found this helpful, be sure to like and subscribe. And if you need any help buying or selling here in Florida, or you need a mortgage, whether it's in Florida, Michigan, or how many states do you work in?
I have my Michigan, Florida, and Texas license, and the company has a Colorado license and a Virginia license. So if I can't work in that state, but we are licensed there, I can definitely refer you to somebody within the company that can take care of you just as well as I would.
Okay, so you heard it for Michelle, definitely Michigan, Florida, Texas. That's a lot of people, a lot of area. I'm sure there's going to be people asking you questions. So, having said that, thanks a lot, Michelle, and we'll see you soon.
Sounds great. Thank you so much.